All right, let's keep this really simple. There's not only imports and exports in trade, there's imports and exports in policies, markets, conditions, economic fundamentals. This morning, Chairman, the Germans auctioned off boons, negative yielding for the first time since 2016. Is it no wonder that our rates continue to get pressured lower for many reasons, including but also outside the notion of our economy slowing? What do you think about negative rates and some of what's getting exported not only from Germany but Japan and China regarding policy and economic weakness?
Right. Well, Rick, as you know, because you live right there on the floor, right, that our bonds are substitute for their bonds. And right now, our 10-year is clearly responding to the negative news in Europe. And the news in Europe, the economic news, is really negative. If you look at industrial production, if you look at German GDP numbers, 3 of the last 5 quarters are looking very close to, if not in recession. Italy's got a lot of stress, and the whole Brexit thing is lurking over all that. And so if you had to say what's different this year from last year, last year at this time we were looking at a weak first quarter, expecting a strong second quarter, but the rest of the world was kind of doing a lot better. This year we're looking at a weak first quarter. We still expect a strong second quarter and rest of the year, but the momentum from Europe and the momentum from Asia is much different than it was last year, and I think that that's what the bond market's responding to.
No matter how powerful an airplane you have traveling through the air, the winds coming at it are going to slow it down, and the more they pick up, the more it's going to exert headwinds. The U.S. economy has slowed a bit on its own, but the big question, Chairman, is how much is being exported to us as a headwind versus our own condition, and even if it's more overseas, what can we really do about it? I like the underpinnings of the economy, but there's little doubt that we're getting affected by our own coming off our best economic levels and much of Europe and Japan really going down the basement with regard to theirs.
Right. Well, first of all, as you know, that since we have a big trade deficit, the feedback into the U.S. economy of negative news around the world is much smaller than it would be for, say, a different economy like, say, Germany, where they really, really care about their exports to us. And if they were to go down because we were in trouble, it would really directly impact their economy. And so I think that basically for the U.S., the question is, as we look forward, that are we more likely to have upside or downside surprises? And I think that the downside surprises really came over the last 6 months and involved the economies around the world. And there's not a lot more negative news that could be worse than what we've seen in those places. But there's a heck of a lot of upside risk in this year, and I think that that's one reason why equity markets have really been able to digest everything. And the upside risk is basically last year at this time, I think there was a lot more pessimism about us moving forward with trade deals. But now we've got USMCA that can pass Congress this year. We've got Secretary Mnuchin and Ambassador Lighthizer flying to China today with these ongoing negotiations. There's a lot of upside stuff that could happen. Meanwhile, deregulation is continuing to gather momentum. We're expecting a lot more deregulation this year. So I think that in the U.S., the risks are balanced to being actually leaning on the upside relative to last year, and that the negative news around the world is something to factor in. But since you can think about things that could break the other way for us, that you should continue to be optimistic.